Good evening and welcome to the Q3 2023 update on Marshall Reddick Mortgage Fund. Thanks as always for being with us. My name is Patrick Prunty. I'm your fund manager working out of our Newport Beach, California office. And it's my pleasure to be joined tonight by our co-host, Vince Tomich. As Vince gets started here, I'm going to introduce him, but we're going to get started with the agenda first. Just the items that we're going to be touching on this evening as we kind of work through the details of this prior quarter, including what's ahead, and break down the numbers in the waterfall as always.
Hey everybody, thanks Pat. My name is Vince Tomich. I am a real estate agent and advisor here at Marshall Reddick, and I work out of the Newport Beach office here in California. Just to give you a little background, my primary role is I help a lot of investors who are seeking to invest in whether it's California property or one of our out-of-state markets. But another big part of my job is raising capital for our mortgage fund. Those of you that are already in the fund know, I've talked to a few of you, but I work with various capital partners to help with the accreditation process and help get you set up with your position within the fund. So super excited to be on tonight's presentation. Just, quick little bit about myself. Was born and raised here in Southern California. I've been in real estate now for over 7 years. And, I'm a big fan of what we preach, right? As a, investor myself, as a current fund holder, it's always nice talking to you folks from, an investor to investor relationship. So really look forward to tonight's presentation.
Totally, and then thanks for being here, Vince. For folks listening, understand that both Vince and I, as well as a lot of our staff, are capital investors in our mortgage fund as well. It's like he mentioned, right? We practice what we preach here, and we're looking forward to sharing those details with you again this evening.
Awesome. So we always like to start out with just a quick little bit of crowd participation. So for those of you that are able to and have access to a computer, if you don't mind, we're going to do a quick poll question here. The poll, I'll go ahead and let Pat launch that, but we're going to ask, do you already have a position in Marshall Reddick Mortgage Fund? So we'll give a couple minutes, or a couple seconds, I should say, to let you guys fill that out, and we'll go from there.
Always good to know, This call is suited for existing capital partners, of course, but also for new folks who are thinking about investing and kind of want to understand, kind of what are the basics about this fund? How does it operate? How does it make money? What are those nuances? Is there a minimum? And so on. So I know we've got some new folks on the call, and just love to have that crowd participation. And thanks for your help. Okay, so we'll just give it another second. We'll go ahead and close the poll. So publishing the poll, those that shared with us, lion's share of folks are existing capital partners.
Nice.
So we do have some new folks that are just learning and open to further discussion. So Vince is going to be busy.
Yeah, absolutely. And, that kind of leads us to a really good next spot here. So for those of you that are newer to the mortgage fund and are looking to just kind of get a brief understanding of what it is, we're going to go over some fun basics for you guys. So I want to kind of go over some bullet points, and I'll let Pat kind of start us off here. So here are just some high level bullet points here, right? So as Pat mentioned, is there a minimum? Yes, the minimum investment is $25,000, and each contribution that you make to the mortgage fund, we do have a minimum hold time. That minimum hold time is 12 months, okay? We have distributions that are paid quarterly. A really cool feature to that distribution is, as you see below, you can elect to take that distribution in a cash form, right? Or in a, ACH, or you can elect to reinvest that and get a little bit of a compound effect. So that's always a nice feature for those of you, especially the folks that are looking for that long-term compounding strategy. This is a great home for your capital. Another feature is you can contribute capital as you desire, right? You're not fixed to only issuing blocks of 25,000, and you're not restricted to only making quarterly distributions. You can make contributions as often as you want, as low as $1,000. But one thing to remember is each contribution is held to that minimum 12-month hold time.
Yeah, just to expand on that a little bit, Vince. The people have started to like the idea of building their exposure to our fund. We strategically designed it to have that low minimum investment so that folks could get comfortable with what we're doing. And as a fund that operates in perpetuity, there's not a long lockup, and there's not just one period of time in which you can get in. So we do have a lot of folks getting on like a regular cadence, whether that's a monthly, quarterly, semi-annual contribution. And again, it doesn't have to be increments of 25,000. Each additional, once you have the minimum, can be as low as 1,000.
Absolutely. And our last item there is just redeeming capital, right? So what we ask is for a 90-day lead time. So after your 12 months hold period, you can, if you elect to liquidate either your entire position or a portion of your position, we ask for a 90-day lead time for us to return that capital to you. That request is done typically via email, and we get those redemptions paid, typically within 30 to 45 days, but we do ask for that 90-day window.
Yeah, the more time you can give us, the better. But we have a fantastic liquidity policy due to a lot of our capital being invested into short-term debt. And so the bottom line is then a great liquidity policy. And if you need to redeem, you can absolutely do so once you get past your 12-month minimum.
Awesome. Okay, so Marshall Reddick Mortgage Fund is a California partnership. So for those of you that are curious in terms of the end of the year and taxes and how that works, you're going to be getting a K-1 as you are a limited partner within the Marshall Reddick Mortgage Fund. So make sure to just talk to your tax professional to get advice regarding K-1 income and how that may impact your financials. This is also a really great home to invest with your self-directed retirement accounts. So what's really interesting is a point that Pat often brings up to me is oftentimes those individuals who I help maybe invest in buy property and collect their mortgage payments through a self-directed retirement account, it's hard to put those monthly distributions to work, right? It has to basically sit into your account until you have grown enough capital to then redeploy it in some capacity. The nice thing with the mortgage fund is if you have invested in a self-directed retirement account, you can elect to reinvest those quarterly distributions so that money is constantly working and you're not having to save up another contribution amount for some other investment.
Yeah, we have a large portion of our capital partners or capital investing entities are indeed self-directed retirement accounts. I think that number is someplace around 25%. It's constantly changing. And of course, one thing that Vince didn't mention is the UBTI, the unrelated business taxable income. There's always been some controversy about that. But we have the advice that what we are doing, there is a carve out for lending operations, which is what we are. And therefore, anybody investing with a self-directed retirement account will not be subject to UBTI unless, of course, we bring on leverage. But we have plans in that event. And currently, and since inception, we have been an unlevered fund lending strictly your equity and ours.
Yeah, good point, Pat. And I know that that's been a factor for some of our investors to keep an eye on. So great pointing that out. Lastly, and this is a really important element to the mortgage fund, is you do have to be an accredited investor. And just to quickly go over accreditation, it's a pretty simple process. Typically, your CPA can issue a letter, but nonetheless, we're looking for a minimum of 200,000 or more for income. If you're filing as a single person, 300,000 or more as a joint, and then or $1 million net worth. So
yeah, you guys can talk offline, those that are curious and that are new here in terms of accreditation. This is a government term, not a Marshall Reddick term. It's very common to the private fund space. And it's just one of those things, but you do in fact need to be that. And Vince can certainly talk more about that, offline on a one-on-one.
Perfect. So, basically the high levels of what Marshall Reddick is, it is a debt fund. The only thing we do is lend money, and how we lend money is in first lien position on residential property only. So it's non-owner occupied only. There's no primary residences here, and there's no seconds, right? That is a critical feature of the fund, and that keeps our, safety intact, and that's, how we've been able to produce such consistent and safe returns over the years. We basically earn money in two forms here. So there's going to be loan fees and interest on the loan. So we collect 2 to 3 points, and our interest ranges from 6 to 12%.
Yeah, the points just are a percent of the loan amount. That's an upfront fee, and any lender in the business, conventional or private, is charging fees that are paid along by the borrower with their closing costs. And then, of course, during the term of the loan, you've got your interest.
Yes, absolutely. So our target return and what we basically, our benchmark has been, is we're looking for a return of 8% annually. So seeking those 2% quarterly distributions is how you would, see that 8% annual. And to elaborate on that, that basically translates to the fund needing to earn about 12 to 13%, right? And the way that the capital or the return rolls up or gets distributed to the investor is in two elements, right? So there's a preferred return that we have of 6%. And after that preferred return is paid out, there's a 50-50 profit share that is shared between Marshall Reddick and the investor. And the way that that's been translating is to that 8% annually.
Yeah, I'm just going to interject just a little bit there. With regard to that target return, we're starting to see the supply of private capital. It's starting to get used up, and the longer that government rates stay high, we're going to talk a little bit more about that. Our outlook for the investor return is ticking upwards. As that supply gets used, it allows us to increase fees and interest rates. So as we'll talk about a little bit more, the forecast is for that 8% number to tick up forward as those increased fees and increased interest rates start to take effect over the next 3 to 4 quarters.
Yep, absolutely. And lastly, we do have a 2% management fee earned by Marshall Reddick. Again, not a load fee, but it's rather an expense to the fund that we are going to be, having on an annual basis.
Yeah, that's not a profit center for Marshall Reddick. That's just, pays our share of the office rent and the staff and all of the things that take to run the mortgage fund. But when we talk about that target return of 8%, that's all net of the expenses, which includes that management fee.
So, we just went over some very high level bullet points of what the Marshall Reddick Mortgage Fund is and how it operates, but Pat has done an awesome job drafting a fantastic explanation through one of our through an article that he wrote. And for those of you that aren't familiar or want to dive in a little bit deeper, here's the URL link to read that article. It's something that I send out to anybody who's interested in the fund as a really good way to get a top to bottom understanding of how it functions, how it operates, and what to expect in terms of moving forward. So we wanted to go into, there's two questions that I often get about the mortgage fund. And one of those is, where can I find the details about the fund? So in addition to, some awesome articles that we've written, we have an amazing platform on our website that details all of the information regarding the mortgage fund. So you're going to be able to see your capital and your returns, the portfolio holdings, the historical performance, all of the paperwork involved, right? The structure, the purpose, the strategy. I think one of my favorite parts about the website is this interactive map that we took a screenshot here that you can see on the right. And basically what this does is this highlights all of the states that we have active loans in or completed mortgages in, and you can click on those states and you can look at the details of each and every loan that we have ongoing and see, what the scope of work is, what the properties look like, the loan amounts, and you can kind of get a really good understanding of the overall involvement of each and every loan and how that looks across the country.
Yeah, and similarly to this session that we're having, the website that you've got the URL to here on the screen is geared towards not only folks that are looking to invest for the first time, but also those existing capital partners, which we know we've got a lot of them on the call tonight. And this is really where you can stay up to date on what our portfolio looks like, what the loan to values look like, what the capital stack looks like. So that's how it was designed. Again, very similar to this presentation for both existing and prospective capital partners.
Yeah, absolutely. So the other question that I often get is how much capital are you managing, right? So, and how do the returns work? So basically, as of October 1st, 2023, we have just over 50 million in capital. And we have an 8.61 annualized return since inception. So what's critical about that is we've had 15 operational quarters, right? And basically those distributions have ranged from 1.96 on the low up to 2.33. And now again, that's net to the capital partners. That's after all expenses and fees, etc. That is what the capital partner is actually earning. So, that's on a quarterly basis. So you multiply that times 4. So the range here is anywhere from 7.84 to 9.32 based on those highs and lows. But again, the annualized return since inception above that 8.5 mark at 8.61 there.
And folks, understand that this didn't just happen. This was by design. This is how the fund was designed, right? To be consistent, to produce yields that can be counted on. This is never going to be a 20% yielding fund, but this fund is also never going to lose money, right? We've got 15 operational quarters through Q3. Q4 is our 16th. And of course, we've got a corresponding 15 profitable quarters with healthy distributions. That's going to translate into the next 15 operational quarters with 15 corresponding profit distributions. It's just how the fund was designed. Again, very safe, first lien, well diversified, good loan to values, non-owner occupied residential real estate.
Yeah, and I think what's really one nice feature on the website is you can track these quarterly distributions since inception, since the very, very beginning. So those of you that want to review the 15 quarters, you can see, how the capital has grown, the investors, the active loans. You can see these line items here and how they've grown and developed. But one thing that is consistent is that quarterly return, to Pat's point, and that's the goal of the fund and how we have been performing. So here's a good illustration of that, right? So this is a good way to represent what the earnings are quarter after quarter. So here's an example from Q1 2020 all the way to Q3 of 2023, and how those earnings are separated from what the partners represent, their partners portion is, and what management gets. So I love this graph, right? Because as you can see, the purple represents the management's portion of the returns, and the orange represents the partners, which are all you folks, right? So it's really nice to see that, this fund is really performing well, and, the greatest beneficiary to the fund is our partners, and we couldn't do this without our partners. So we really are thankful, and we want to reward them and can make a consistent contribution and make this as seamless as possible moving forward. So this is a good illustration to that.
Yeah, I'm also going to comment right here and come out. A lot of questions I've had over the last couple of quarters is there a downward trend that I'm seeing here in the distributions? And I'll say that that's not the case. Again, we can't bat 1,000, but we're in no jeopardy of losing principal. I mean, we're distributing, as we're going to dive into, plus $1 million in profits this quarter. And so there's many factors that go in, namely the competitive nature of the private lending business, given the volatile government interest rates. So a lot of those private folks out there are really starving for yield, and it's making it difficult. Right? We've had a hard time raising our rates while keeping the capital working. But again, that supply is all working through, and so the demand is very strong. But I just don't see any correlation to a downward trend. I think sometimes we're going to be over 2%, and I think sometimes we're going to be under 2%. But I think that the range of up or down is going to be very tight within that 8 to 9% range, depending on, of course, how long government rates stay high. So Vince, thanks for the overview. I'm going to dive into sort of some of the meat and potatoes I prepared for everyone. Some really cool metrics that we're going to talk about. But a lot of folks, they get hung up on, what the waterfall looks like. So I want to talk a little bit about total net income and our profit and loss, as well as what that waterfall looks like. So first off, what's the waterfall and how does that work? Right? How does this fund operate? So the bottom line here, and this is taken from Investopedia, that the waterfall is just like, how are the profits or the distributions allocated? Like, what's the pecking order, okay? And are there hurdles that have to be crossed? And that's exactly how our fund is set up, but our waterfall is very simple. Okay, and the bottom line is that when it comes to the waterfall, we are quarter after quarter distributing 100% of total net income. I have that highlighted because I'm going to show our P&L from the third quarter on the next slide or two, and I've highlighted that number there. So when it comes to what we're distributing, again, 100% of total net income in the following order. Number one, do we need to reserve any funds for potential loan loss reserves? And we're going to talk a little bit, a question I get commonly is, what's the loan loss reserve? We have that towards the end of the presentation. But number one, we've got to get through a hurdle of paying the investors first. So that's a 1.5% per quarter or 6% per annum preferred return. Marshall Reddick does not participate in the profit share until after the investors have earned 1.5%. And these percentages, again, are based on your capital account. After you've received your share of the preferred return, that is when Marshall Reddick will share in the profits equally with the capital partners. So it's a 50-50 split of the balance of funds once the hurdle of the preferred return has been reached. Very simple waterfall. Then, as I mentioned, we're going to dive into, here's a screen clip of our profit and loss. And we publish this, it's on that website that we've created in an effort to keep transparency open so everybody understands the health of the fund. So not only is the P&L there, but the balance sheet. But this from the quarter shows, of course, our gross income, our expenses, as well as that net income, which is in this quarter, 1,213,209. Now, how does that break down? Again, this is the waterfall. Number one is that 1.2 million, when waterfalled or calculated against everybody's capital account, represents 2.47%. All right, so that is what gets divvied up. The loan loss reserve in this quarter was 0. No need. The fund is in great health and no allocation to the loan loss reserve this quarter. Now, of course, we've got our preferred return that I mentioned. So that's 1.5% of the capital. So again, that percentage times everybody's capital account based on their number of days in the quarter. Some people entered during the quarter, some people exit during the quarter, some people's capital was static at the start and the end of the quarter. But that calculation at 1.5% comes out to the 753,000 number. Okay, then moving along, that means that we've got 459,000, almost 460,000 in profit to be split. So that represents 0.97% of the capital, and that's split equally amongst the partners and management. So net to the capital partners, we've got 1.985% in this quarter, again, based on your capital account. And that's a summation of your preferred return and your share of the profits. So again, a very simple waterfall.
Yeah, and Pat, I think what's really nice about breaking this down, I know we issue the quarterly distributions, every quarter that have this kind of breakdown, but it is nice for you to go through this. So for those of you that have seen it before and maybe had some questions, this is a really good illustration to really break that down into finite figures for you.
Yeah, I'll address a question from the crowd. They asked if we could enlarge the P&L. Unfortunately, I can't do that on the presentation. It's a photo. I'd have to take it down, and we don't want to do that. But if you go to the mortgage fund due diligence page that we talked about, I've posted the letter that I've issued last Friday to all the capital partners with the earnings report, and the P&L and the balance sheet is attached to that letter. Again, that I emailed it to all the capital partners and I posted it to that page. It's public for everyone to view. Okay, so let's take that a step further in the waterfall and how it affects you and your investment. So I'm going to use just an easy number. Again, we have 2.47 net, and after the waterfall, that breaks down to 1.985 to the capital partners. And if you had, as many people do, a $200,000 investment in our fund, and you were static and invested for the entire quarter, start to finish, you would have earned a preferred return of $3,000, a profit share of $970, for a total of $3,970. Which, if you take $3,970 over $200,000, that's your 1.985 in the quarter. And again, just to kind of come full circle on how that waterfall works. If you'd like to annualize that, right, because that's a quarterly return, although each quarter is a little bit different and is never going to be the same, you can simply multiply that by 4. If we did have a static exact same return in every quarter, we would end up with a $200,000 investment. Considering your share of preferred return and profit share, you'd end up with a little under $16,000 based on the 1.985 we had in quarter 3.
Yeah, that's great.
All right, some great things to share with everybody in terms of portfolio metrics and our rundown on quarter 3. So as we get into some statistics here, and I love sharing this level of detail. So our partner stack, or our number of investing entities, continues to rise, not in an unsustainable way, in the other effect, in a very sustainable way. So we have 254 partners today, or that was as of October 1st, excuse me, across 22 states. So a lot of folks are getting involved. 27 of those are Marshall Reddick staff. So again, as we talked about, we practice what we preach, and this is a huge benefit to our staff, who understands the safety and the consistency, and they're using it in a lot of cases almost like an IRA or a 401k to help them build wealth over the long term. When it comes to the amount of capital, we've shared that we ended the quarter with a little north of 50 million. And again, the staff representing a good percentage of that, roughly 10%. And I really take pride in the fact that our staff is investing in this fund alongside of a lot of our tried and true capital partners who have known Marshall Reddick for many years and many decades.
Absolutely. And I think, as you know, as a fundraiser or someone who helps raise capital for the fund, it's always easier for me to talk about things about the fund as an investor myself, as a capital partner, and being able to share that, just that camaraderie and, that level of involvement. It is definitely something where I have used and leveraged that's, given me great benefit. I used it as a savings account to acquire enough capital to purchase a investment / primary that I now live in. So super excited about that. And I think having the employees or our colleagues in it is really important.
Yeah, I've got a quick comment from the crowd, which I'd be happy to address, and it talks about how much growth in capital can the fund handle projected over the next 2 to 5 years, given the current staff level. That's it's complicated, right? But what we won't do is over raise, and I think we've shown that in the consistency of our capital raise. Going out and raising $50 million tomorrow is going to help nobody. We're going to get cash drag or yield dilution in that case, and so we kind of systematically raise as every quarter. We raise someplace between 2 and 5 million, and it's like, can we keep this newly increased capital stack working and deployed in loans 100% of the time? And as soon as we're comfortable with that, then we'll do a little bit more capital raise, right? So if we needed to, we could return capital. you'll see as we continue on here that there's no lack of demand, so there's no need to return it unless, of course, you want it back. But how does that then play into the staff level? Staff level is constantly increasing. Marshall Reddick's got someplace between 120 and 135 staff across our 5 states and 5 individual brick and mortar offices. So we're not a super small business and we're not a super large business, but we're constantly hiring and tweaking and improving things, especially on the technology side. So we're very tech forward in terms of building out efficiencies that help us manage the capital and our overall private lending division with not low staff, but the right amount of staff. So our goal in this fund was to raise 100 million, and over 15 quarters, we're halfway there. I'm feeling absolutely fantastic about the modest and controlled growth that we have. Thanks for that question. Continuing on here, the investments, the mortgage investments, this continues to rise, and it's certainly something that we show on that mortgage fund page. So each quarter, as we've slightly increased the capital stack, we've been able to increase the portfolio of mortgage investments that are active and that are performing and that are paying interest right now. And so the larger the portfolio, the more diversified. And the fact that we're across 22 states in which we have a footprint, makes me sleep extremely well at night. And what makes me sleep even better is the fact that 75% of these are secured by single family homes, right? Which is the most easily valued, the most easily tradable asset. We are not the fund or the debt lender that is going to be able to lend on 100-unit apartment buildings. That's just a totally different animal, and there's only certain people that can play in that space, and we're in the very simple space, right? All residential, and again, we love single family homes or small multifamily duplex or fourplex. As far as the loans receivable, again, I'm going to point to the balance sheet. So that 235 loans represents an unpaid principal balance as of October 1st of just under 60 million, right? So again, well diversified across good operators in good states, and we're feeling great. As far as how that translates and what I've learned in terms of risk when it comes to lending money is that it's all about loan to value. And this is one of the metrics that I point to when people try to ask me to quantify risk. The lower the loan to value, the lower the risk. And so, you know, we've got 50.61 million in capital from all of our partners, right, which has funded 59.5 or roughly 60 million in outstanding loan principal, unpaid principal balance, or UPB, and that is secured by 94.5 million in cumulative value across those 235 collateral properties that are securing our equity.
Yeah.
So again, I can't harp enough on how this metric quantifies risk for anybody looking at investing in this fund.
Yeah, absolutely. Thanks for pointing all this out, Pat. One thing that, you know, I often get, you know, questions about, and something that I think might be worth highlighting here on our presentation tonight is I notice here that there is a $50.61 million capital amount that we have. But if you look below, there is 59.49 million in loan principal, or UPB. Do you mind just kind of explaining, you know, how that is in a little bit of the differences there?
Totally, happy to do that. So the UPB, let's back up a second. A lot of the capital or the loans that we fund are in short-term loans that are either renovation projects, right, the property's being improved, or even new construction, ground up. Okay, and so obviously as a safety mechanism, we're not giving the borrower 100% of the capital from day one. They've got to do things and spend their own money before they can draw down on the other amounts that make up the total loan amount. So the difference between the equity that we have and the unpaid principal, or UPB as you're calling it, is going to be those construction dollars on hold. right? So we are on the hook for those monies. They can be called periodically, and they are. We're releasing someplace in the neighborhood of 50 construction draws per month. And one of the coolest parts about that, folks, is that for 60 or so percent of that difference, of that, what, roughly 8 million or so, we get to earn interest on. That's called a Dutch interest, right? Which is different than a bank, right? A bank only charges interest on money that it's released. Whereas on a lot of our construction draws, they're paying interest on the full loan amount from day one, even though we haven't parted with it or put it up at risk. So again, that's a yield enhancement as well as a safety mechanism.
Wow. So to simplify that, we have 50 million in capital, but we're earning on 59 million essentially.
You could say that. It's not quite all of that. We do have some loans that we're only earning interest on the amount advanced, but 60 to 65% of that difference we are earning interest on from day one.
Awesome.
So I'm kind of diving into a little bit more statistics and getting a little granular on you here. We've talked about that we have 235 loans and that we've got an unpaid principal balance of 59.5 million. So let's talk about the loan purposes and the breakdown of the count of loans in the portfolio as well as the principal balance in the portfolio. And the loan purpose comes to the types of loans that we make. So we make renovation loans. Those are a fancy way to call it fix and flip loans, or we lend to a lot of we buy houses for cash type operations. We also are getting more involved in the ground up new construction side of the business, right? So that would be considered build. And then we also have a large presence in the bridge scenario. Don't get confused on what bridge means. We aren't any equity lenders. We aren't junior position lenders. These are still first lien positions, but bridge generally means that there's no intent to renovate. And so the borrower is likely using us for transactional funding before they just sell the property or they get time to refinance it with a conventional lender. Then, of course, we also have some element of a little bit longer term loans, call those hold loans, call those rental loans. But we've quantified the breakdown in loan purpose here by both count. So the top level in terms of like renovate, for example, at 104 and the 44.26, that is the count and percentage based on 235 in the portfolio, whereas the green line item that's slightly indented for both of those, take the UPB of 26.88 million and the 45.18%, that's based on the 59.5 million that's in the portfolio in terms of unpaid principal balance. So again, a really good metric to kind of dive in and give you the breakdown. One thing I think is cool here, and you're going to even see that more on the next slide, is that the top 3 bullet points there, renovate, build, and bridge, these are all hyper short-term loans. And this is really important. So I think that represents roughly 85% of the capital is in the short-term debt, which allows us to collect the capital back. Right? We have a maturity, they've got to repay the loan. It allows us to recycle the capital, earn more loan fees, right? Reset the interest in the face of a volatile interest rate market. So we feel really great about this as compared to, some lenders who have stacked their books with a lot longer maturities and loans where they're hooked into like a fixed interest rate and the inability to recycle the capital for additional loan fees.
Yeah, absolutely, Pat. That's a really good point. 85% is in that short term. So it really protects us, like you said, from locking in those low yields and always being up to market standards of where current rates are.
Yeah, it's one of the reasons that I think now that we're working through the supply of private capital that's out there, that's going to allow us to raise our fees and our interest rates, we're actually going to have the payoffs to be able to deploy into those loans that pay higher fees based on again, the supply of private capital being exhausted. So same kind of setup here in terms of the loans in the portfolio and the unpaid principal balance. This time we're going to break it down not by loan purpose, but by loan term. Again, just to kind of quantify the nature and the term of the loans that we offer. So obviously the lion's share of the capital in loan terms of 12 months or less. right? We do have some element there in the middle, 13 to 36 months. Those would be bridge loans, whereas the 36 to 60 would be some element of bridge or hold. And then we do have some element of longer term loans with maturities of greater than 60 months. But the one thing I would point to there is that is a very small percentage of the capital compared to the total, right? And those are very stable loans. Those are going to be our lowest loan to value loans that just pay like lockstep every month and add value to the fund as well. So kind of some other metrics here to kind of round out what's happened in quarter 3. So the prior slides were all as of quarter 3. This is going to be during the quarter. So awesome that we had no new defaults occur in Q3. And interestingly enough, some prior defaults that we had, we actually received repayment during the quarter.
That's amazing. One thing that I want to point out here, Pat, is when you said 2 prior defaults repaid, meaning we had 2 defaults in the past, and that basically translates to, understanding that the defaults don't necessarily mean loss of principal, right? I'd love for you to kind of dive into that because that word obviously has a negative connotation, and I would like you to kind of relay to the investors what that kind of means for us.
Yeah, no, absolutely. Default definitely is a negative word, and defaults, of course, are a part of being in the lending business, okay? But we lend non-owner occupied only, so it's a business decision. It's not an emotional decision when it comes to the borrower. So yeah, default simply means that maybe they fell behind on their payments, or they've missed the property tax payment, or they've let the insurance expire. There's many forms of default. And again, as you mentioned, Vince, it doesn't equate to a loss. And I'll tell you an interesting story about one of these defaults that was just repaid. This default actually happened in quarter 4 of 2022, and the borrower just had some, unfortunate family issues happen, was going through a nasty divorce, and he fell off the radar. He fell behind on his payments, and he forced our hand. So we got a lawyer involved, and it was a judicial foreclosure state, so it took some time. It's about 9 months round trip, I think. But we just kept forcing his hand, filing all the paperwork that was necessary. And we had a good enough loan to value position on a really nice asset that when it came down to it and that sheriff's sale, that auction style sale was scheduled, guess what? The borrower took action. He up and got another lender to refinance the debt for him. And guess what? We got paid in full, all unpaid principal, all accrued but unpaid interest, all lawyer fees, all advanced forced place insurance. So guys, a default sometimes works out exactly as it's supposed to, and that wouldn't be the first time that that's happened. So again, just know that defaults are part of the business, but they don't actually mean anything negative. It's just we've got to take action to protect our interest in the property.
And I think that first lien position that that's mandatory for us is a critical part of how we protect our investors' capital.
So in terms of the capital raise and the redeem during the quarter, right, 2.25 in new capital coming into the fund. That doesn't include capital automatically reinvested, which is a metric I'm going to talk about here shortly. And then of course, for folks that, one of their concerns might be is like, what's the liquidity policy and can I get dollars out? Absolutely. Most folks are investing in this that don't have need for liquidity, but if you do, because you have a life event or you want to invest in real estate if the market turns or whatever it is that you need the capital for, no problem. Let your 12-month minimum ride, right? Give us as much time as you can, lead time that you need the capital, but we're going to make it happen. So redemptions are healthy. And even in the face of redemptions that are regular, now that we're 15 quarters, now in our 16th quarter, we're able to handle those no problem in less than the 90-day time frame allocated in our business plan. As far as the earnings, which are the profits, so we talked about that already, that we're at the 1.22 million for this last quarter. And as that breaks down, I love this, that 530,000 or 0.53 million was left in the fund. I personally am a reinvestor. I don't take any of the distributions. I let them stay in the fund and I earn on those earnings in every subsequent quarter. And a lot of folks are doing the same, right? So that's a really cool metric about additional capital that's staying in the fund and that continues to earn starting on the first of the following quarter. And then of course, some folks, right, they want those cash distributions and no problem, right? So the other element of that is the 680K roughly that was withdrawn from Q4. As far as loan origination, our best quarter yet, which I would suspect that as capital continues to rise. But one of the reasons that we had the best quarter in terms of loan origination with 60 loans originated during the quarter to the tune of just under 15 million is that we had a fierce number of payoffs within a short period of time. Which is awesome, right? Again, that's those short-term maturities of 6 to 12 months, and that flipper or that wholesaler or whomever is getting that property sold, they're repaying that capital, and we're able to deploy it as fast as possible, oftentimes within a day or two, to continue to boost that yield with loan fees and interest. So just to wrap up kind of Q3, just know, as I sort of alluded to and I answered one of the questions earlier, is that our letter that all of the folks who are in the fund get from us, on the third full week following quarter end. So that was last Friday, October 20th. I went ahead and posted that letter on the mortgage fund due diligence page. It includes the financials. So if you ever want to go back there, and then these are hosted historically as well. They're also posted inside your online portal, where of course you can log in at any point in time and see your distribution history and your earnings history, and where you can add new capital and you can get your tax documents at year-end time and all of that good stuff.
And guys, I just want to encourage you, if you ever have issues or struggles finding any of this documentation or information that you're seeking out, don't hesitate to reach out to myself or Pat, as we are happy to guide you in the right direction and make sure you get the content and the information that you are looking for.
Okay, so what's ahead, right? That's probably on a lot of people's mind, and we're feeling great as we head towards the end of the year here in quarter four, and as we kind of look ahead to 2024, it's gonna be an interesting one with an election coming. And some people are sort of like, how are things going, right? The stock market's had a little bit of a tumble lately, but again, how our fund is built is just so stable, right? Good loan to values, very well diversified, and we're going to kind of get into some more of the demand for private capital issues here. So in terms of what's ahead, as I mentioned, the supply of private capital is starting to have been exhausted, where over the last, I'd say, 6 to 8 quarters, when the government rates have been rising, there's been a lot of private capital out there that needs to get deployed. So it's made it very competitive in terms of raising fees and rates. Certainly you can't do that the same way as government rates, which are artificially being raised. So I'm looking forward to that. Probably in the month of November, we're going to have a fee and an interest rate raise. And then over the next 3 to 4 quarters, that's going to factor into that yield. I think that's going to drive that distribution percentage coming into 2024. So as I mentioned, continued solid earnings, profits, quality distributions. I think that those that have been in with us since inception and those who have gotten in at some point and been along for the ride or have spent time looking at the historical details that are on that website, we're hitting those distributions, and you can count on that. So the demand, as I mentioned, it's starting to increase. And it's always been a market for private capital, and we represent such a small percentage of what this overall market in the United States looks like, but it's changing too. It's not just your flipper anymore. It's not just your wholesaler anymore that's utilizing private capital. And there's some interesting reasons for that. Vince, you want to?
Yeah, absolutely. So, I work a lot on the real estate side of our business, right? And what I've noticed is, I'm seeing a lot more qualified conventional buyers opting or at least looking at private money as an option for acquisition, right? So traditionally the difference in spread between a conventional rate and a private rate was so far and so great that the only folks that did private financing are the folks that had to or that were forced to via, guidelines. Whereas now I'm seeing that even conventionally approved borrowers are seeking out private lending as an alternative. For example, we have a lot of builders who are interested in issuing seller concessions, and conventional lenders are restricted to a 2% sales price limit, where we as a private lender are not. So builders who want to offer more, a conventional lender can't do anything with more than 2%, whereas we as a private lender, we can take those funds, we can take that capital, and we can improve the interest rate. I've seen it to the situation where we are getting conventional or borrowers who are getting lower interest rates through our private lending than conventional, and that's because of the points that builders are contributing. And that doesn't mean a loss of yield to you as an investor. We're getting that money up front from a point percentage. So it's not to say that you're getting less here. It's really as a way to say that we're taking some profit share or some share of what conventional lenders are typically getting.
Absolutely, and I think that's going to continue to rise. I mean, real estate people, as I've learned over the last 20 years of working with Marshall Reddick, are some of the most creative people, right? Really good real estate operators find a way to make money in any market, up, down, sideways, you name it. So I want to kind of dive in a little bit more about the demand and talk a little bit about the government interest rates. So it stems from the fact that a lot of capital partners that I talk to on a regular basis are looking at this and they're saying, geez, the conventional rate's gone up like, I don't know, 10 times. And, it's such a high number. And why aren't you raising your rates in the same cadence? And the bottom line here, folks, is that the government is artificially meddling with the interest rate that's out there that the conventional lenders have to lend at in order to sell the debt to Fannie Mae. And that's their only tool to try to tame inflation. And God, let's be honest, it's not surprised that we have inflation given the, all the money that's been given away in the various number of years that we've had artificially low rates. And again, we're not going to get into all that tonight, but the bottom line is that these government rates, right, are driving what the rates that conventional lenders have to lend at, versus that government rates are not driving the private mortgage rates, right? The private market is set by just that, the private investors who out there and what their yield demand is. Now, I'm not saying that they don't somewhat work together, but it's a lag, right? So initially, as the government raises those rates, private lenders can't do it as quickly, right? They're going to lose market share in terms of the borrowers. And I think it's way worse to have capital sidelined waiting for higher yields than having the capital invested 100% of the time in good quality loans. So understand the difference there. And then the good news is I'm starting to see the supply kind of be exhausted and restrict, which is why now I see the opportunity for us to start raising that without scaring off those quality borrowers with which we've worked with for the better part of a decade. It's crazy too, as what's going on here. I mean, we're very close, Vince and I, with Reed Hazard of CMG Mortgage. He's like our conventional lender and been a good friend and an ally and a colleague for almost 20 years. We talked to him today, and it's just shockingly that the conventional 30-year fixed with no points is now 8%. It's an interesting dynamic, and I won't be surprised if that continues upward.
Yeah, and it definitely makes it a challenge for borrowers to try to make sense of real estate acquisitions at that price point. And it does give us the ability to start to tweak our rates and ultimately increase you as the investor's yield. But as Pat said, we have to keep the money working, and that's a critical component to the mortgage fund, and that's why we have been very careful as to how we make adjustments to our private lending rates.
Yeah, so looking ahead, 2024 could be a tough year for some. I think a lot of folks probably on this call and that'll be listening to the recording are going to have the same sentiment, especially with an election coming. We're just not quite sure what's ahead. But I think that our mortgage fund is yang to that yin, or whatever you want to call it, right? We're sort of non-correlated to a lot of that, and we're uniquely positioned for success given the diversity of what we're doing, right? And the demand for private capital. And sort of as Vince alluded to, and I think we've got a unique competitive edge here when it comes to the fact that we aren't just a lender, right? A lot of lenders out there are just lenders, right? We're not. We've also got a good brokerage, real estate brokerage arm, and a good property management arm, which keeps us connected to all of those clients who constantly have a need for private money, especially in the face of rising government rates, where that conventional, the spread between conventional and private isn't what it used to be. So we're just about to wrap up. We're going to run through some like commonly asked questions. So if there's any others that are going to be coming from the crowd, please feel free to fire those off. We'll attempt to get to as many as we possibly can. You ready to go, Vince?
Yeah, absolutely. So the first question that that we often see is the subscription versus operating account, and what's the policy? So Pat, I'll let you kind of dive into that a little bit more and go into some detail.
Yeah, well, let's just kind of run through and quantify each of these, because I'm going to be addressing them, slide by slide. We will touch on like what the policy is, and that was a big thing in Q3, so I'd like to address that. We'll also be talking about, what everyone else is thinking, right? If the market softens, how's that going to affect your fund?
Yep.
I'm sure you've thought of that. How do we make money? That's an important one. You want to address that right now?
Sure. Yeah, I'd be happy to. So basically, basically the fund is making money through our, like we said earlier, right? Through collecting loan fees and through our, the interest that we charge, right? So that is something that we do, with all of our borrowers. And then we ultimately are able to issue our distributions to you. As Pat mentioned earlier, there's a preferred return as well as a profit share element to that. So that's how the fund is generating our revenue and ultimately distributing that to you as a capital partner.
Totally. All we do is lend money, right? So the only money that we make is loan fees for arranging those loans and interest paid by the borrower on those loans. I wanted to address that because that is one I realized that we don't have a slide for. But we're also going to address the loan loss reserve, like I talked about, as well as the steps to invest. So moving ahead with the policy and the subscription versus the operating account. Bottom line here is that every time you invest in our fund, we take that capital right away and it's deposited into our subscription account, right? This is what I call the waiting room. And what are you waiting for? You're waiting to be admitted into the fund as a member of the fund, okay? We desire to admit you as fast as humanly possible, right? We don't want to hold your money in the subscription account any longer than as humanly possible. And it's generally not a big deal. Historically, since inception, the average wait has been 23 days. And in some cases, the shortest wait's been 0 days, meaning you deposit it, we move it over to the operating account and deploy it into a loan immediately. However, although the paperwork, our business plan, allows for 90 days maximum in the waiting room or in the subscription account, we've never even been close, except for in the Q3, right? Where we saw the longest wait time that we've had since inception, and that ticked up to 77 days, right? There was 2 investors that were there, and ironically, one of those was a personal contribution of my own. Right? I'm investing regularly at a regular cadence. I'm putting in several $1,000s per month into this fund as I build my exposure and build my capital stack here. And I'm no different than anybody else, right? There's all in the same queue. It's a first in, first out. And the bottom line again is that this is a mechanism, and it's used to avoid yield dilution, right? This is not to the detriment of anyone. This is actually to the betterment of all partners who are already invested in the fund. If I just take everyone's subscription and I deposit all this new capital into our operating account, and I have to start paying returns on that money from that day when that money hasn't been deployed into a loan that's earning money, I am now diluting the returns of all of the partners who have previously invested, whose money has been deployed into loans and is the reason the fund is earning money. So everyone that's been in the past has gone through the same weight room at whatever the time frame was for them, wherever that situation was. And this is a one-time situation for each new contribution, right? So like myself, the few $1,000s I'm talking about putting in every quarter, I put it in, it goes into the subscription account, right? Then it waits until we're ready to deploy it into a loan. It's the loans I'm stacking up in our pipeline. And then as soon as possible, I'm moving it to operating and then deploying it. The one caveat is that reinvested earnings, those that are not being withdrawn, that are automatically staying in the fund, those do not go into the subscription account. Those stay right into the operating account, and they start earning immediately on the first of the following quarter.
That's a great clarification, Pat. And to your point, the idea that there's only one wait period is critical. That's the only downtime that your funds are seeing, and once in the operating account, your funds are earning in perpetuity, which is amazing.
Yeah, and again, the average is 23 days. It's not significant, but for those looking for a little bit more insight into that, the wait is generally the shortest immediately before or immediately after quarter end. It's always a mad dash to the end of the month, and then especially to the end of the quarter, where we're trying to deploy into as many loans as humanly possible. And that's been the farthest since our last quarterly distribution was announced, when people are all feeling euphoric about, oh, this is still working, it's still paying me the same amount, right? So it's right then. So if you're looking for the window of when your wait is going to be the shortest, it's going to be that week or two right before quarter end, and that week or two right after quarter end before we announce the earnings report. And then for a little more insight on the longer wait times, these are random. We can't even control them, right? This is a situation where we get a spike in loan payoffs. Okay, when loans pay off, the money is deposited back into that operating account, right, which is already earning because it's already been moved from subscription from whenever it was. And so I have to first deploy funds in the operating account from payoffs before I can look to dip to my subscription account and move over new people, right? Because I'm trying to maintain a high yield to my capital partners, and I want to avoid at all costs any form of yield dilution. So if there's a wait, that we've got a spike in payoffs, which is obviously a great thing, and I'm deploying that money just as fast as possible, and then I'm stacking the pipeline in order to be able to dip into that subscription and move you over as fast as possible. I'm sure this one's on a lot of people's minds, right, in terms of the market and what it's going to do. I alluded to this a little bit into the letter that I issued last Friday, and the fact that existing home sales and the inventory of available homes is just so crazy low. I think a big function of that is that a lot of us are sitting on 2, 3, 4% interest rates that we've all refinanced or purchased with over the past few years. And so this is really, the residential real estate market has remained super resilient. Commercial, I can't say the same, right? There's definitely some blood in the water, and probably a lot more to come on the commercial side with shorter maturities, on adjustable rate mortgages, and low cap rates, right? With a lot of vacancy in a lot of those commercial buildings. But I expect that our mortgage fund is going to be unaffected by a softening in the real estate market. And the primary reason, again, for that is going back to loan to value. The lower the loan to value, the lower the risk. The borrower's equity is what's at risk in a market softening, right? But if we've done our homework and we've lent against good collateral assets that are going to hold their value, a market shift or a soften of 10, 15, 20% is not going to affect the debt holder. certainly there might be a slight increase in the default rate. That's probably normal. But again, the diversity and the quality of our assets with the loan to values that we have, especially coupled with our loyal borrower base who values their relationship with Marshall Reddick, I just don't see us having a huge effect in the face of a market soften. As I mentioned, the residential real estate market remains resilient. I mean, I don't know about you folks, but still multiple offers on any property that comes on the market in my neighborhood here in Southern California.
I would say that too, competition is still there. It's going to be market dependent, but ultimately, that 1 to 4 space is ultra competitive, especially, on certain price points that we're delving into.
Yeah, and then even in the event of a correction, right, or a spike in that default rate, certainly the yield could be affected. But let's just take this quarter for example. I mean, we're $1.2 million profitable, right? That means we'd have to have 50% of the borrowers not make their interest payments, and even if that happened, right, we'd be at half of what that profit was. So then we'd have to have, I don't know, 50% of the loans on top of that, go into a state of default where we have to start advancing attorney's fees. I mean, we're talking about a catastrophe scenario, right? In a situation that I just don't see happening, right? So a correction, no problem. Could be an effect on the yield. You might see that trickle under the 2% number in the event of some kind of market soften, but the quality and diversification of the portfolio is too great that a loss of principal is just so far improbable. Let's talk about the loss reserve. I get questions about this a lot. It wasn't a big issue because we put no allocation of our earnings in Q3 into the loss reserve. But the bottom line is that the loan loss reserve is very common in the private space, in the banking space. And this is just a small amount of earnings that could potentially be set aside to cover loan losses, which could be renegotiating or modifying loans. It could go loans that go non-performing in terms of making their interest rates or other forms of default. Again, I think the fact that we lend non-owner occupied really keeps us out a lot of the trouble here, where banks who are lending mostly owner occupied get into these situations, especially when they're government regulated and the government tells them, hey, you can't foreclose. We don't have any element of that, right? Everything that we do is a business purpose loan, and it's a non-emotional decision. So our operating documents allow for us to hold anywhere between 1 to 6% of net assets under management, which is roughly that 50 million number that we've been talking about. Typical for debt funds is around 2% of that NAUM. We're currently holding less than 1%, and it's just a function of the fact that our fund is just operating in lockstep. Few, if any, lates, few, if any, defaults, and we're just really excited about the strength of our portfolio.
Yeah, Pat, and thanks so much. And as we close it out, guys, I just wanted to go over the quick steps to invest in the mortgage fund. Now, I know most of you on the call here are already gone through this process. So, for anybody who wants to add to their position, it's basically from step 4 on, right? You're signing a subscription agreement and depositing funds. But just for those of you that may be newer, the first step is going to be to book a consultation. I will be doing follow-up calls after this presentation just to kind of recap, answer maybe any questions that may have been left, so we can go over whatever you'd like to go over then. Next would be getting accredited. Like we mentioned, it's a pretty straightforward process, and we definitely have some avenues that can help expedite this. And then setting up your online portal. That's where you have the ability to track your investment. That's where you can see your quarterly distributions, how much capital you have, what the distributions have look like year over year or quarter over quarter, and then signing your paperwork, right? So we're going to have a subscription agreement that goes out that details, the title of the investment, whether you want to take distributions, reinvest them, how much, etc. And then ultimately, last but not least, is to wire your funds, via wire, and we'll be able to provide that information to you.
Yeah, the QR codes that you see there will take you to a URL on the website where you'll be able to sign up for that consultation, or for the portal access, or for the wire instructions for the subscription account where you'll ultimately deposit that contribution.
Yeah, and in closing, guys, ultimately now is still a great time to invest in the mortgage fund. It's designed to produce low risk, consistent stream of income that can be counted on year over year and quarter over quarter. We showed that today with 15 straight quarters, and we continue and forecast to see the same. So as you know, all backed by first lien debt, which is so important. And as Pat mentioned, it's all residential real estate, which is the most tradable asset in real estate. Offers non-volatile. It's an alternative to the stocks and bonds, right? So stocks and bonds have been so volatile that this is definitely a more consistent path to growing your net worth. And it's perfect home for your self-directed retirement accounts. So those of you that have capital sitting in self-directed retirement accounts and you have the ability to park it in any asset or any investment, this is a great home for those funds as well.
Yeah, absolutely. Again, thanks everybody for joining us. We couldn't do this without the capital and of course without you, Vince, so I appreciate you being here. It's always my pleasure to join and to share kind of my perspective as the fund manager on how the prior quarter went, as well as what we're looking into the next quarter and into the near term on the future.
Yeah, thanks so much, Pat, for your time, and thank you all folks for joining this evening. We really appreciate the attendance and look forward to connecting with you guys soon.
Have a great holiday season. Bye-bye now.